Hey, this is Jeffrey with another edition of Stock Smart, the March 2nd, 2021 edition. Hope you're doing well. After a big move yesterday where we saw a 3% rise in the NASDAQ, we're still a bit oversold, believe it or not, in the S&P 500 oscillator, which measures overbought and oversold conditions. A little bit oversold. Today we're going to have a little bit of a pullback, it looks like, as we got a little too heated up yesterday. We're going to be down probably 1 or 2% in the oscillator after the end of the day, it seems like. And the positive move yesterday may have been a bit too big, as the market's still a little bit unsure of itself. And we're going to get into this dead period here where we're not going to have as many catalysts as companies leave the earnings season. And we're going to have a dead period here of about 4 to 5 weeks until we get into bank earnings again, which will start it off all over again. We'll have catalysts. So VIX is slightly up today, about 1%. Nothing too concerning. There's still $700 billion that's waiting in money market funds that's been there since we've had the whole COVID and our recession that we've had. So there's still a lot of money on the sidelines waiting for these dips. So a good strategy right now is to probably keep a little extra powder. And if you see an opportunity, buy. We are going to get more and more oversold slightly, I'd say, in this next 3 to 4 weeks. Not dramatically, but slightly. Like we're going to get a day like today where we're going to be down anywhere from 70 basis points probably to 100 basis points today. Then tomorrow we'll probably get a little bounce back up, maybe get some of it back. And that's what I would expect for the next like 4 to 5 weeks. So we're looking at the utilities yesterday. We're talking about utilities. I just wanted to talk more. We did this charting thing we did, and I took the 10-year treasury and put it on top of the XLU, which is the ETF that tracks utilities. And if you look at that over the last 3 months, it's pretty indicative of what we talked about with inflation going up or the rise in interest rates. And that 10-year treasury, over the last 3 months is up 50 basis points, up to about almost 1.5%. And we have a decline in utilities. Utilities in that same time period almost down 5%. So again, that's a great inverse corollary position showing you that when bond prices go up, utilities go down. You couldn't have a better inversely correlated situation right there. GameStop, still very interesting. And I wonder if this is a time when you can look at GameStop now and say, hey, maybe we do have support somewhere around 100. That's a number where we've seen GameStop settle in a bit. It seems unlikely, but perhaps people are holding a little bit longer, going to see what the new Chewy CEO does and how they turn around this company. Because could they go and be a competitor in a space like, what I always thought about GameStop is, why isn't it maybe like a Netflix? Why didn't they go online sooner and create their own network and channel of online video games? Using the same concept as Netflix does for videos and TV. And we see so many competitors. I mean, Netflix was dying itself. When Netflix was doing that 3-mail CD thing, that was all right, but it didn't achieve the spectacular growth it's seen until it went all online with streaming. So wondering what, when GameStop goes that direction, this could be viable. But how does it get out of the 5,000 leases it's in? I mean, that's one of the problems. It's going to have to find some other way to use those. And, commercial properties, if you go to malls have this problem anyway. There's plenty of open spaces in the malls. If you want to rent a mall space for your baseball card store and lose all your money, there's plenty of space in the malls to find one. So, that's a problem for GameStop. They still have a lot of hurdles, but it seems like it's found some support somewhere in the $100 range, which is kind of interesting. It blew through and, a month back, it blew down to 45. That seems like that might be the support. But now it's establishing a regular support range somewhere in the 100 to 115 range. So that's going to be interesting. That has to build over time to really be valued or a qualified support level for GameStop. But we are seeing continuous buying. It's up again today, 3%. The shorts, again, are not that heavy in GameStop. Very light in the 30 to 35% range. That is not an extreme short at all comparatively to where it was when it was maybe up to 100% short or over 100% short with the synthetic shorts that were going on. So let's take a look at a stock.
STOCKWATCH.
Or in this case, a basket of stocks or a stock group or a sector. Commodities. So the clearest sign that we're seeing inflation is commodities. And most people don't directly invest in commodities because you'd have to do complicated futures contract which are extremely risky. You have to be extremely knowledgeable. Commodities traders know like one thing. They'll know a grain, or they'll know the oil, or they'll know a wheat or something specific, or pork bellies. They know that. They know everything about that. It's a really tough marketplace. So most people don't have a direct access to the futures, contracts in the commodities world. But this is an area right now the smart investor wants to be in, because we're getting inflation. What is inflation? It's directly the prices we pay for goods. And we're seeing that in many goods. And if you look at the commodity price indexes and changes, we already talked about it about a month ago. We talked about how energy has increased. So let's take a look at the increase in commodity prices over the last 3 months. Energy up 15%. Non-energy, 4.66%. Agriculture is up 2%. Beverages up 1% approximately. Food prices up 3%. Raw materials up about 2%. Fertilizers up about 2%. And metals and minerals up about 11%. And then precious metals up about 50 basis points. So this is inflation. It's right there looking at you in the face. Prices are going up, and that's because of cheap money. As the Fed continues to print money, our dollar goes down. The cheap money increases the price of goods. And that's what we're getting. And therefore, then interest rates rise with inflation. So let's say, who's a perfect investor for commodities when interest rates are rising? Well, they have to protect their portfolios. So a fixed income investor who is at risk to inflation would be a natural investor in commodities. So the same investor who is investing in things like utilities, who is now moving away from utilities, is now going towards commodities as a potential investment. And you can see that happening. And a good way to do this is not by getting in each individual commodity. The best way to do this is pretty simple. It's very complex to know if I should be in copper or wheat. Get into a basket of commodities. Buy a simple ETF. DBC Invesco's Commodity Index. Up 15-16% this year already. So in just this 2-month period, commodities up 15 and 16%. It's boring. You're not going to want to go out with your friends and talk over drinks and say, hey, I just bought this really exciting stock. DBC, Commodities Index. Wow, it's super. But it's up 15%, and that's worth talking about. And so we're going to continue to see this. So your hedge against inflation is being invested in commodities. So you ride it right along with everyone else. And and some people may want to get access to specific stocks. There's some good stocks that you can get in there. Dow Chemical, commodity, doing very well. If you want to play this via regular company, Dow would be a great choice. Or Freeport-McMoRan has been on fire because of the rise in home building. So, if your hedge is generally buying gold, maybe you want to get into a company like Freeport-McMoRan where you get the diversified metals industry and you get access to something that's actually usable, where gold may be usable in some aspects. You have something like copper, which is exploding in growth, 50% up over the last 5-6 months because of the home building boom. So when you put your pipes in, you're putting in copper pipes. It's expensive. Copper's going way up. So maybe instead of using gold as your hedge right now, you want to be in a diversified company like a Freeport-McMoRan, who's done extremely well. That stock up huge, up again today, up 2% in a down day. But year to date, the return on Freeport-McMoRan is 36%. And the chart's spectacular, by the way. So that's FCX, Freeport-McMoRan. And again, they're taking advantage in this shortage in copper. Gold, of course, always in demand, but a lot of precious metals. So a great idea there. So I got a question from Frank.
The average investor.
One more thing I want to say about commodities. An ETF like the DBC pays a dividend. It pays 25 cents a year per share. So that's also extremely attractive to an investor who is a fixed income investor. So as you see the move out of the utilities, you'll see the move into certain things like commodities, again, which will protect against the rise in inflation. So I got a question from Frank. And Frank wants to know about what we talked about yesterday. And he said that he's asking, I said that the 2.5 would be the key number on the 10-year note, and he wants to know why. And, again, thanks for the questions. Keep them coming. Appreciate all the questions. Podcast does continue to grow at a rate of about 10% a week, and so that's exciting to me as well. Well, again, this investor that we want to call the fixed income type investor, and don't get kind of confused by the term fixed income. Fixed income generally refers to things like CDs, money markets, and bonds. But they are safe, and they're looking for yields, dividend yields, 3 to 4%. So if you can tell a fixed income investor, or let's say a portfolio manager. Now, again, what we talked about on the show is portfolio managers have been pushed into the risk curve the last 2 years because bond prices are terrible. So with bond prices terrible in the years past, they had to go in and put their clients in riskier positions. They are excited to put their clients now into bonds and other fixed income products that have less risk. So when we talk about the 2.5% on the 10-year note being a number that's going to be scary for equities, it's because of this. So when you look at a return, people are trying to get a low beta in a fixed income type portfolio. They're looking for a low beta stock. And that's low beta means essentially it's a measure against the S&P 500, the return. So you have a benchmark, S&P 500. Let's say that the S&P 500 returns 10% and the beta of a position in equity is 0.70. That means that it will return 70% of the S&P 500, or in this case would be 7%. That's what beta is. So when a fixed income portfolio is looking for low beta, meaning good return, safer stock, not a lot of deviation, and then a dividend potentially. So a good stock that pays a regular dividend, Dow was one that we talked about earlier, that pays a dividend around 4%. So when you get, and that has risk because it's a company. But if you get a note which has no risk, again, because the only risk it has interest rate risk. But if you can get a note for 2.5%, that's backed by the US government, which doesn't default, always makes its payment, against a equity that has a 3 to 3.5% dividend, you're going to go in that 10-year note with the 2.5%. So that's why 2.5% is a key number. I would say a benchmark or a number to watch as interest rates continue to escalate. So hey, thanks for listening. Another great show, and we'll see you again next time on StockSmart.